Welcome to Different Makes a Difference, where we discuss investment matters that matter to everyday investors. Join Odlum Brown's equity analysts as we examine pertinent topics in today's markets and look at things a little differently. Odlum Brown is an independent Canadian investment firm. We provide integrated wealth management solutions to help clients achieve their financial goals, and we've been doing so for over 100 years. Join us for some lessons we've learned along the way that can make a difference for the future.
Hello, welcome to Different Makes a Difference. I'm Stephen Boland. Anyone who has ever bought an investment product is probably familiar with the disclaimer that the past may not be indicative of the future. They're among the most ignored words in finance. However, those words may be particularly true today. The tide appears to be changing, and there are ways you can prepare for a future that is different than the past. For this conversation, we're joined by Odlum Brown's Chief Investment Officer, Murray Leith. Welcome back, Murray.
Hi, Steve.
So, Murray, you wrote recently that investors have been focused on Iran and artificial intelligence, but that many are missing an even more important story, a story unfolding in the bond market. What's getting your attention there?
Well, interest rates are rising, for one. That's sort of the headline. But we look back at where we've come from. We've been through an extraordinary period, a very long period from 1981 to 2021, which was a disinflationary period, which means that was a period of generally, not always throughout, but where inflation and interest rates fell. And that had the effect of lifting valuations across all asset classes and virtually all geographies. And it's been a wonderful ride for investors. It's created a lot of wealth. But after the inflation that came out of the pandemic, because of all the monetary and fiscal stimulus, we're in a different world. And investors need to realize that in a different world with a different inflation and interest rate backdrop, a lot of the old relationships and rules that people, came to depend upon are not going to be the same relationships going forward. The main example that I can give you is that both the Bank of Canada and the Federal Reserve in the US started lowering administered short-term interest rates in 2024. And normally when that happens, longer-term interest rates come down with it. And that's exactly what happened every time they lowered rates, going all the way back to the beginning of the 1980s. But this time, long-term rates went up. And that is a strong signal that it's a different world. And that's important because interest rates influence the cost of capital for companies that borrow. And it also impacts the discount rate that investors use to value future cash flows. The higher the discount rate, the lower the present value. And so we had this amazing rising tide that lifted valuations, but the tide is now going out. So that changes how you should be thinking about the stocks you want to own.
So why is this change happening?
For a number of reasons. Probably the biggest is the change that Donald Trump is leading for the United States, this new world order where the dynamics of global trade are changing, and on account of some of the wars that are going on around the world. Resiliency and national security are now a lot more important than efficiency. And, America made a choice. Donald Trump blames China and the rest of the world, but they really made a choice over time to prioritize corporate profits when they made the decision to take advantage of globalization and businesses offshored labor to cheaper labor overseas, primarily in China, to enhance profit margins and overall profits. And it's been an amazing ride for investors. But America found itself in a place where the consequences of that choice meant that you hollowed out the industrial base of the country, you destroyed communities, and really undermined the wealth and well-being of the middle class. And so that's part of the reason why you have angry voters. And Trump leveraged that. And so America is embarking on improving its resiliency, which means reshoring, reindustrialization. He's pushing the rest of the NATO countries to rearm, as is the United States. So all of these things sort of point to higher inflation, these capital spending cycles. And they're happening alongside governments led by the United States that have big debt and big deficits. So there's a lot of competition for capital. And that's happening as savings rates are coming down, in large part because the baby boom, the population's aging and now spending the money that they've saved for retirement as opposed to investing it.
So you mentioned higher interest rates, and higher interest rates generally mean lower asset values. Does that mean we need to be cautious on all stocks, all assets, or are there areas more exposed than others?
It's frankly hard to make a broad generalization because the generalization that I would make is that, most of the time great companies are great stocks, but some of the times people pay too much for them.
Mm.
And so a great company is not necessarily a great stock. And for a long time, we were riding winners, great companies. After the financial crisis, their valuations were very beaten up. They were out of favor, in large part because they were very expensive at the turn of the century, and the sentiment pendulum had swung the other way. But those valuation multiples expanded as the companies grew, and we and other investors were riding that wave, and it's been phenomenal. And the business and the story and where it was going is all that really mattered. And you didn't need to pay too much attention to price. But now that we have a different interest rate backdrop, price matters a lot more. So we're really focused on the price you pay for growth. And you can't pay too much. That's something to worry about.
And we've seen this before. Maybe tell us a little bit about the 1970s Nifty 50 and when you were running the Odlum Brown department, the Odlum Brown research department in the late 90s. We want to have one of these sentiment cycles as well.
Yeah. There's a group of stocks in the early 70s, as you referred to as the Nifty 50, IBM, Polaroid, Kodak, Coca-Cola, all the household names that frankly, most of them went on to just continue to do very well. But the valuation multiples got too high. And then in the 70s, we had some oil crises and the consequences of printing too much money caught up with society. And we had a lot of inflation, and those valuation multiples came crashing down that more than offset the growth in the underlying businesses. So it was a very tough period for investors in quality businesses in the 70s. Valuation multiples bottomed in the early 80s when Paul Volcker, the chair of the Federal Reserve at the time, took interest rates to 20% to kill inflation. And that, frankly, was the setup for a phenomenal couple of decades that culminated in the technology mania or the internet mania in the 1990s. But it wasn't just a technology mania. America's biggest and best companies, Coca-Cola again, got to very high valuations, once again setting the stage for disappointment. And the interesting thing, those stocks, that the best companies were horrible performers in the 2000s, simply because the valuation multiples needed to come back to something more reasonable. The interesting thing is that happened against a backdrop of falling inflation and falling interest rates. So even though rates were coming down, which should have been biasing valuation multiples up, they were going in the other direction. And I think of sentiment in the stock market as operating on a pendulum. And the pendulum was at an overvalued, euphoric extreme at the turn of the century. And it didn't stop at fair value. Fair value was probably valuation multiples had fallen in half or by a third by 2005, which is actually when we started our major push into America, when we were getting bought out of resource companies that were getting taken over in Canada. But the sentiment swing didn't stop there. It went to an undervalued extreme on the other side of the great financial crisis in 2008. But then once again, setting the stage for another big rally afterwards. So we've seen this play before. And in fact, we wrote a paper in 2009 with that title in it, and we could write a rerun of it again today. But we're at a different point in the cycle, and I think we have to worry about the pendulum swinging the other way from where it was in 2009.
And these were still awesome businesses throughout that, Coca-Cola, McDonald's, etc. It's just, as you say, they got a little bit too popular and the pendulum swung. Interestingly, I joined in 2005 and thought it was great. We're buying these awesome businesses at the best price they've been in for years. But it took us a long time. It took a while for it to actually pay off.
I would say it took a long time for them to really pay off in terms of helping us beat the market.
Yeah.
And we really did from like, I think 2011 to 2015, 16. It's been tougher to sort of beat the market since, because the crowd sort of figured out that these are great businesses and people have paid up for them. But it didn't really hurt us. And in fact, owning these great businesses helped us as we went into that financial crisis in 2008. They went down less than other stocks. And not actually in the US market, it actually helped us in Canada because the Canadian dollar went down a whole bunch in that period. So the translation from US to Canadian dollars was more advantageous. So, it wasn't much of a consolation. The market went down 50%. We might have gone down 35 or 40%. And fortunately, it was short-lived, and the authorities put stimulus into the system, and we got back on our feet pretty quickly. But
so when we think of some of the great businesses today that treat people very well, and maybe in some cases the valuations are high, it's hard to make blanket statements here, but are there fundamental risks to some of these as well? Like whether it's disruption for software, or you've talked a bit about concerns that might not be priced in around antitrust. Is there headwinds fundamentally for some of these great businesses as well?
Well, that's a great question, because we're sort of talking about the foundation, or the underlying tide. And we had 40 years of a rising tide. And, we don't know if it's going way out, but it's not coming up anymore. And so we have to keep that in mind and focus on the price that we pay. And then what else do we layer into that thinking? And, this year, the software stocks have been hit very hard because there's this worry that they're going to face competition from artificial intelligence. And some of them probably will. Some of them have deep moats and defendable businesses, and they'll be fine, and they'll actually leverage artificial intelligence. But the sort of the starting point, or the setup for these businesses, is that they had been extraordinary businesses. They were able to raise prices for their customers year in and year out. People that subscribed to these software services renewed at a very high rate. The businesses didn't require a lot of capital, so we'd call them capital light. Very high returns on capital, very high margin. And they were priced very expensively because they were ideal businesses. They're perfect businesses. But when you have such a great business and you're making so much money, that attracts competition. So, we would have said, and we didn't own a bunch of software businesses, and nor do we today, frankly, but we weren't interested because the prices were too high. There wasn't much margin of safety. One never knows what risks are going to, come out and bite you, but economics and history teaches you that if the profit pie is big, somebody's going to come and try and take a piece of it. And in this case, the competition's coming, or the fear of it's coming from AI. Another, thing to think about is that, it's been decades since there's been, really a lot of substantive antitrust behavior or action on account of governments. And, there's been this tremendous consolidation and concentration that's happened in almost every industry. And it was done in the name of scale and efficiency. And that was very true in the beginning. But, we're probably to the point where, is society as a whole benefiting from this? And, the clearest example in the here and now is what's going on with the AI revolution. The build out of the data centers is happening so fast. There's a shortage of memory and some of the semiconductor chips. And because of that, those guys have been able to raise their prices through the roof and they're making gobs of money, the memory makers, and it's putting a lot of pressure on companies like Apple. I think Apple has raised the prices on their various products probably an average of 20% because the memory components are a lot more expensive. There used to be lots of memory producers, but the consolidation over time, there's only three major ones in the world. And I think society starts to say, well, maybe this isn't serving us well. Like, I don't know when or really if it will happen, but there should be some sort of discount for that possible risk in it. And that's when stocks have very high valuations, there isn't a big margin of safety. Like, you don't need to know what the risks are, but there should be some allowance for the unknowns or even the known risks if they're going to rear their head. And so, that's what's been happening in various pockets of the market is valuations were very high. The valuations were pretty high on some of the Magnificent Seven technology companies, and they've actually come down because the markets correctly, I think, recognize that these used to be businesses that didn't require a lot of capital-light businesses, and now they're investing hundreds of billions of dollars that's eating up their cash flow. They're even going to market to raise equity and debt. So, the returns on capital, at least right now, are not as good as they used to be. So those valuation multiples come in, frankly, to the point where I think they look pretty attractive again. And I guess the market today actually thought that as well. Microsoft in particular was one of the stocks that had seen real contraction in its valuation multiple. And we thought it had gone too far. And they just released a good quarter yesterday. And I think the stock was up 15, 18% today.
Yeah. So sounds like need to be picky among some of these popular names. It doesn't mean everything's going down. You mentioned price matters. Nearly 2000s, you didn't recommend the most popular names, and the market, the S&P 500, the US market struggled, but by owning less popular, good companies, just attractively priced, you got really good returns. You talk about a great opportunity set back then to recommend attractively priced securities, attractively priced alternatives to some of the most popular. What's the opportunity set like today beyond your most popular names?
Unfortunately, not nearly as good as it was at the turn of the century. Back then, outside technology, outside the mega cap US names, here in Canada, across pretty much all the sectors, with the exception of telcos and few technology names like Nortel that we had, there was great value. And we had we have a lot of good companies in this country, and their valuations were very much at the low end of the historic range. And that's simply not the case today. There's reasonable value out there, and reasonably valued good businesses are going to do better than bonds. And so, the long-term investor wants to own those things. It's just, I don't think the opportunity is there to knock it out of the park like it was at the turn of the century. But there are pockets of value. We recently recommended a couple of engineering stocks and added them to our model portfolio. They sold off alongside those software companies on fears of AI competing with the business. We think it's overblown in that space. But the valuation multiples came down to, price earnings multiples anywhere from 15 to 18 times for businesses that are going to grow, double digits for the next number of years, because these engineering companies participate in these multiple capital spending cycles that are out there, whether it's the data centers or rebuilding the electrical grid and the power that needs to feed into that. There's critical mineral investments and reshoring that's going on. There's an aerospace capex cycle. Water systems are being rebuilt, defense and rearmament. These engineering companies participate in all of this work. So growth at a cheaper price.
Right. Pick your spots. And how does that compare to if you bought an index today?
Well, I think an index, going back to the turn of the century, Canadians were tripping over themselves to get more U.S. and exposure to the S&P 500, and certainly Warren Buffett endorses the S&P 500 as being a great way for most people to participate in the stock market. And as I said at the front end of this conversation, like most of the time, owning good businesses, which the S&P 500 is full of, is a great idea. But every once in a while, like every decade or two, maybe every 2 decades, the prices get too high. And that S&P 500 in Canadian dollar terms fell by a third in the 2000s. I don't think the setup's anywhere, nearly as bad it is, but, it led the world for the last 10, 15 years. I think the odds that it leads the world is very low going forward because the starting price is too high. It's a very concentrated index in popular and pricey stocks, many of which are hitched to the AI revolution narrative, which is fantastic. And, we don't think for a second that it's not going to change our world and drive productivity, et cetera, just as the internet did at the turn of the century. But people have too much exposure to one bet, and they're paying, in many cases, too much. And then, so we just really think people need to diversify outside of that area, and they have to diversify with some focus on price too. And then when we look at our own market here at home, it's very concentrated in financials and resource stocks. That's probably 75% of the market. That is not to say we want to own things in those areas, but we also want some diversity elsewhere. We'll get diversity in the US market. And when I say I don't like the main benchmark, it does not mean that I don't like the US market. I think we will always like the US market. It is so deep and broad compared to any other market around the world. And, just as we found value at the turn of the century in Canada, we could have found the value in the US market, just not in the big names that everybody liked that were the dominant companies in the benchmarks.
And how do bonds fit into your current outlook?
Everybody's different. They have different time horizons, different objectives, different tolerance for the ups and downs in the market. But everybody should sort of think about, what's the mix that's right for me, given my goals and constraints. Whatever that mix is, or you have a range of, at any given time, I'm going to be between X and Y% in equities and the same in bonds. I think people should be leaning more to not just, fixed income than equities, because I think it's more attractive. Interest rates are higher than they were. They were next to nothing for a long time. So you can actually get a return on your fixed income now. We don't think people should own long-term bonds. We think they should keep their durations, the term of the fixed income that they own, relatively short. We think corporate credit, high quality corporate credit, is a good idea. We don't think it now is a time to be moving into lower quality corporate credit, because the extra yield that you get above governments is pretty tight by historic standards. So you're not getting paid for that extra risk. So keep the durations of those fixed income portfolios shorter. And we're arguing the same thing and doing the same thing on the equity side of the businesses. We're making sure we're not chasing the sexiest, fastest growing stocks out there and paying, nosebleed prices for them. We're looking for the balance between getting decent growth. We'd love companies that can grow, better than average, better than the general economy, but we want to be really disciplined on the price that we pay for those businesses. It's harder today to find great value in the stock market. I think part of it's driven by the fact that people recognize that we live in a riskier world. There's more debt in the world. Geopolitics is different. Social unrest is worse. And so quality is more important in a world like that. And generally over my career, my insistence on quality has gone up, not down. So you want quality, but so people have figured that out, generally. And I also think quality businesses, it's hard to believe, but in 2009, after the financial crisis, they were the cheapest businesses around. And it's because that sentiment pendulum had swung from that overvalued extreme, or, a euphoric extreme, to a really pessimistic, panicky extreme on the other end of it. I remember back then, it was really hard to convince people to buy stocks in the United States. That was the epicenter of the financial crisis. They thought that America was going down the toilet. and I'd say we don't buy countries, we buy individual businesses. And, most of the businesses that we buy, if they're listed or headquartered in the United States or here in Canada, a lot of them are global businesses, and it's where a company does its business that matters, not where its stock or headquarters is.
One last question. We're talking about the need to do things differently than the past. And certainly in recent years, riding great companies and seeing them go up and up and up has been a rewarding experience. And it's really difficult to get off that bus behaviorally, to sell your winners and move into something else and pay tax gains along the way. How do people get over that hesitancy to change, to get off the past winners and maybe move into something else for this new world that you're describing?
Well, I think the short answer is that it's very hard for people to do it. Human beings are, they suffer from greed and fear. And when times are good, people want more. They want more of what's working. And generally, what's working tends to work in the short term. So if you're going to be different, you have to get comfortable with the idea that you're probably going to underperform in the short term. And, what drives us to be different, I think, are a couple of things. One, I like to win, and it's the long-term race that really matters. But I think more importantly is that when markets are running and investors are getting more and more excited and pricing starts to get detached from underlying fundamentals, the risk of permanent loss of capital goes up. And, that's what really matters at the end of the day for clients. And so the tough part is that those risks build and nobody knows they exist. It's human nature to, I always joke that, the way a lot of people define risk is, if it went up, it's not risky. If it went down, it's risky. But that's not the way we're wired. It's, if a price falls in half of a good company, that to me is a lot less risky than what it was before it had its drop. The way the academics look at risk, they measure it through volatility. And so the volatility of the market at the top before it fell in half was half of what it was at the bottom. So academically, you'd say the market's twice as risky after it's fallen in half. Well, that's just nonsensical. There's a way bigger margin of safety at the bottom than there is at the top. And so these are the things that we factor on. And the longer the market runs and valuation multiples go up, we worry about that downside more. So that's what drives us to be different. But you have to have patience and you have to hold hands along the way.
Well, being different has certainly paid off for you and your investment track record. And it looks like we're at one of those points in time when it could pay to be different again. So thanks, Murray, for joining us today, helping us understand some of the big changes out there. And when the facts change, so too should we. We still want to recommend high quality companies, given all the uncertainty in the world. But a good company is not always a good investment. Price matters. And to do well in a changing world, as mentioned, we need to look a little differently than in the past and also be willing to look a little differently than the crowd. So thank you, everyone, for listening. We hope you're having a nice summer, and we'll talk again soon.
Thank you for listening to another episode of Different Makes a Difference. Just as every individual is unique, so are your financial circumstances. Be sure to talk to your professional advisors for advice related specifically to you. Our podcast is for general information purposes for Canadians only. The views expressed are those of the presenters and may not reflect the opinions of Odlum Brown. Be sure to check out our full disclaimer and subscribe to the podcast at odlumbrown.com/differentmakesadifference. Odlum Brown is a member of the Canadian Investor Protection Fund.